Everyone, let's get into a question that we had and go over this subject. It says, I would like to know how to choose the best contract to purchase to reduce, I think it's risk and greatest ROI. So let's get into that. So the number one question is going to become, what is your time frame? If I'm, for example, day trading a stock like NVIDIA, well, I'm just going to go ahead to the options and go ahead and pick, for example, a weekly expiration since I'm day trading it. Rule of thumb, when you're doing short dated options, so that would be like the weekly, so today's Monday, these expire this Friday, NVIDIA is about 120.5 per share. I would pick either the at the money options, and this is a good rule of thumb pretty much for all of trading. The at the money option, so that would be the 121 puts if I think the stock's going to go down, or the 120 puts. There's about a 50-cent difference between the two. The 121 puts are going to be a little bit more expensive, but a higher probability of working out than the out the money puts. But also with that, if NVIDIA goes down drastically, the out the money puts will pay a better ROI. So with higher risk comes higher ROI, with lower risk, lower ROI. But I like picking for day trading. Let's say I was going to pick something long, maybe Afram here hitting the scanner, and I wanted to day trade this name, which usually moves very well out here. I could pick something like, and here we go, Afram giving me a long on the master indicator. I could pick like the 32.5 calls that are out the money or the 33 calls. So right, something specifically right at the money or one strike out the money. Now you do see the ones that hit the scanner were the 31 calls. So these are going to be more expensive that you can see. They're about 224, but from options are a mark to mark move depending on the stock price. So you can see when I say mark to mark, the in the money options are up about 320% today, which is great, fantastic. But you see like the 33 calls are up about 444%. So you're looking at about 100% difference or so in terms of ROI, but obviously these out the money calls have a higher risk. And since the stock is having what we call a greater than expected market makers move up around 10% today, the cheap options. Now let's say I was swing trading. Let's say I wanted to do a nice swing trade on a stock, no weeklies. So let's not look at these weeklies here. Maybe I want to look at, let's go ahead and pull up Afram. Let's say I wanted to swing trade Afram. We're getting here a nice long signal on the master indicator. So I would go somewhere, depending on how long I plan on holding the position, something like, rule of thumb, maybe July. So right around that 30 days out, maybe I'm going to hold it for 1 to 2 weeks. And I would pick pretty much the same. 32.5 calls to 33 calls. Not much of a dollar difference. You can see usually the one with the tighter bid ask and more volume. I usually like to gravitate towards those, depending obviously if I'm trading size or not. So rule of thumb, at the money or one strike, out the money is good. Find out, do you want to day trade? Do you want to swing trade the stock? Does the stock have earnings upcoming? Like for example, I'm long some Verizon calls and some T calls. Verizon was showing a weird P&L. By the way. So I know like T has earnings on July 24th. So the July 26th expiration will capture it. You can see if a stock has earnings usually by the IV increase in the options, or usually if you go to a chart, let's say in T, it might display it. Looks like it's not here. Let's see if we could get that. No, it's not here on TOS, but you can see here the earnings about July 26th. So look too for that catalyst. If a stock has earnings upcoming, like to give you an example, Carnival Cruise Lines has earnings this week. I need to be aware, if I want to hold that position through the earnings event. And we'll get into that on the next video.